I'm so excited to be here with my friend Tera Thomas from FranFund. Hello, Tera.
Hi, Dave. Thank you for having me. I'm very excited to be here.
Well, it's delightful to have you, and it's great to have you as a valued partner as a consultant with FranChoice. I thought this opportunity would be good for my audience to hear from you. A few things. Tell us what FranFund is all about.
Sure. So FranFund, like its name, really specializes in franchise funding. We offer a couple of different funding solutions, which I'm sure we'll get into a little bit today. But we really just work with candidates in a consultative and educational approach to make sure that we're finding the best funding solution for their interest in small business ownership and franchising.
That's awesome. So I have the pleasure of introducing my candidates to Tera early on in the process so they can think about their funding strategy as they work through the process of investigating franchises that are a really good fit. So what about Tera? What do you do, Tera?
So I'm a senior funding consultant with FranFund, and I have been with FranFund now for just about 5 years. I've been in the franchising industry for over 20 years, and I've been a franchisee myself. So I know what, your candidates are going through, some of that healthy fear that's happening, and finding out, what's going to be the best fit for their dreams of business ownership and their funding goals. So what I really do is I think of myself as a funding strategist. I work with aspiring entrepreneurs because most are very unsure of where to start. They're unfamiliar with options. They're overwhelmed with information. So I help them to identify and execute those strong funding solutions.
Well, that's a lead into my next question, and I appreciate that. So talk about funding strategies for a potential franchisee.
Sure. So there's lots of different ways we're seeing people using to fund small business opportunities today. I think that the most popular, if you're looking at debt funding, is still the SBA loan. The SBA stands for Small Business Administration. Those are loans that are not lent money by the government, but the bank is lending money to the business, and then the government signs a secondary guarantee. So that's the easiest way for some debt financing. As far as debt is concerned, while we don't facilitate home equity lines of credit or HELOCs, we also see that as just a popular way that people are using, using some equity in their home and leveraging that. And then cash is always king as well. We have a lot of people who can self-finance or use eligible retirement savings to invest into a business without any income tax or early withdrawal penalties. That's also a product that we facilitate and we specialize in, and that's called the ROBS program, and that stands for Rollover for Business Startup.
Excellent. So let's dive into the one that you talked about, debt financing through SBA. Share a little bit about the base qualifications a candidate should think about when they are getting ready to talk to you.
Sure. There's kind of a number of things that a lender is going to look at when they're evaluating a small business loan request. Sometimes I refer to them as buckets. They kind of all need to be equally full, but if one is a little bit overflowing and one is a little less empty, they kind of can equal each other out. But first and foremost, banks always is going to look at the category of credit. So they want to see about a 680 minimum credit score, no recent bankruptcies, foreclosures, or short sales. So just a favorable financial history. They're going to also want to see that whoever's looking to become a franchisee, that they have some equity and some skin in the game. Unfortunately, we don't have any lenders who are interested in lending 100% of what's needed to start a business. So today, most of our lenders are pretty comfortable for a startup of about a 20% cash injection. So if you're looking at a $250,000 project cost, for example, you would be putting in $50,000 or the borrower, and then the bank is lending you $200,000. Usually the largest portion of that cash injection is by paying a franchise fee. So that counts towards that cash injection. They also like to see that you're not putting every dollar that you have into the business and that there's cash to fall back on. A third thing, they do want to see some outside income coming into the household. Banks are just pretty conservative, and they know that business is not going to make money on day one. So they like to see that there's enough outside income to be able to cover the borrower's personal expenses, along with that new SBA loan payment for about the first 12 months of operation. So whether, you're married and your spouse is going to continue to work while you run the business, if there's rental income, if it's a semi-absentee opportunity, whatever that looks like, but that income does become important when you're looking at doing some financing. And then last, if you're looking at something that is brick and mortar, so think of something where there's build out and construction, your clients are likely coming to you versus a service-based business where you're going to them and it's a higher project cost. The banks will also likely require some type of personal collateral on that loan. And the first thing they would look at is real estate. So they would place a lien on real estate that the borrower owns, like their primary home or an investment property, and then the equity would serve as the collateral. Once that loan has been paid off, the lien would then be removed. For loans that are beneath about 350 for like service space, we have some lenders that are more flexible with not requiring that personal collateral. Although, just to be aware, on an SBA loan, the borrower is always signing a personal guarantee, just saying that if or when, for any reason, the business cannot afford to make that monthly loan payment, that they are personally responsible for that debt and securing it with any and all assets.
Awesome. One question I get from my candidates is, well, I have a good relationship with my bank, and I think they do SBA lending. And, I share my thoughts with them. And, we're not selling anything. We're offering the best opportunity for our candidates to find the right funding strategy. What would you say to a candidate that is also talking to a bank that's maybe not as familiar with franchising?
Sure. So the national approval rate for somebody walking into a bank and obtaining an SBA loan is about 37 to 38%. Oftentimes because their banks aren't doing SBA loans because they're not familiar with the franchise, because they don't do that size of loan or that industry. FranFund has a 99% success rate in terms of obtaining loans for people that we provided a pre-approval letter to. And that is because, and there's nothing wrong with going to your local bank if they are interested in SBA loans and they're maybe familiar with the brand, but we work with lenders across the country that we have educated specifically on the franchisors that we work with. So it just becomes a much more efficient and less painful process than if somebody to work with a local bank. We help them to package their loans. So things like their business plan, financial projections, performas, we provide them with templates, offer suggestions, and then we make sure there's a nice red bow on it before we shop it to our network of lenders. And we're shopping it to people that we know are interested in that size of loan, that industry, that geographic area. So it just becomes a much more efficient process.
Excellent. Well, thank you for sharing that. So let's jump into talking about the ROBS program. Share some insights into some key things about ROBS, maybe either qualifications to use ROBS or some of the key elements of ROBS that provide a favorable financing strategy.
Sure. So again, the ROBS program stands for Rollover for Business Startup. It sounds many times when I'm talking to clients about it, they think it's some type of loophole within the tax code, but this is part of the IRS tax code. It's been around since 1974. And really it allows people to use their retirement savings and invest them into a business without any income tax or early withdrawal penalties. You're not qualifying for anything, so you're not really applying. So credit score, income, collateral, those things do not come into play. This can be used in combination with an SBA loan. We have a lot of people who use ROBS for that cash injection that I mentioned for an SBA loan. So the qualifications for this program really just means that you would have to have a retirement account from a previous employer, because most employers will not allow you to roll out or access funds while still employed. So if somebody has a previous, if you change jobs or moved and you have a previous employer 401k, a 457, a 403b, maybe you were, in the military and you have a thrift savings plan or TSP, all of those types of funds and rollover IRAs are eligible. The only accounts that are not eligible are current employer plans, as I mentioned, and then very specifically Roth IRAs, because you've already paid income taxes on those savings. But basically, I could talk about ROBS for a long time, but the simple thing to think about is it's not a loan. You're not taking it out as a distribution. So there's not any monthly loan payment or interest. Basically, what you have the ability to do, Dave, is say, hey, instead of investing into Google or Apple stock, I want to invest that money into my own business where it can continue to grow. And so many of our clients have seen that they get a much better return while investing into their own business versus the traditional market.
Excellent, excellent. Well, those are some super thoughts. Any challenges with the ROPS programs that a candidate should consider as they work through it?
Not really. I mean, that process is also the fastest means to funding outside of writing a check if you have the cash. It takes us about 3 to 4 weeks to go through the ROPS process. But really, the only thing is in that strategy, you do have to operate as a C corporation instead of being like an LLC or an S corp. And that is part of FranFund services. We create that C corporation for you. And then the other benefit is you also have a real retirement plan that is sponsored by that C corporation that you're able to participate in and offer to your eligible employees. So there's that added benefit as well. Like I said, we have a lot of clients that will use this to self-fund their business, start the business debt-free. So without the overhead of a monthly loan payment, their business is going to cash flow faster. But also, let's say it's a $500,000 project cost and they need $100,000 or 20% to get an SBA loan. So many of our clients will use a combination of the two, or maybe they're looking at multiple units or territories. So really, it's just the ability to kind of capitalize on those pre-tax savings and have them working for you and your business.
Excellent, excellent. Tera, have you had a chance to look at the recent changes to the SBA programs?
So there hasn't really been any changes to the SBA programs in general. The 7A program is the most standard program that we see that can be used for startups, acquisitions, working capital. We're seeing some changes in interest rates, obviously, because today SBA loans in general, you're looking at a 10-year term. And so that's going to be congruent with most of your franchise agreements. Interest rates are at Wall Street Journal Prime plus 2 to 2.75. So today that is at 10.75. So as that prime rate has moved up the last year, we have seen the interest rates go up. It is a variable rate that is always adjusted quarterly based on prime. So it will go up and down during the life of the loan. And, while nobody likes to pay more interest than we did a year or two ago, we're seeing that with, homes and cars, everything. To put it in perspective, if somebody were to borrow $200,000 on an SBA loan and the interest rate changes by a whole point, the monthly loan payment's only going to change by about $100 a month. So, again, it's all real money and nobody wants to spend $100 more a month. But if the business can't afford to do that, there's probably some other underlying issues.
Right. So on an operating basis, in most cases, you can manage any adjustments to the interest rates.
Sure, absolutely. So, and again, it'll go up and down during the life of the loan.
Well, folks, as you can see, Tera Thomas is super sweet, super informative, and I love introducing her to all of my candidates because she takes good care of them. Thank you, Tera, for joining me today and sharing your thoughts on funding strategies for potential franchisees.
You're welcome, Dave. Thank you for having me. I appreciate your partnership.